Hello, my dear ACCA students. Welcome back to ACCA Moxie. I'm Neeraj and ACCA. Today, I'm going to start the financial market and treasury function chapter. In this chapter, we will understand the financial system and the treasury function. The financial system includes the financial market, financial institution, and financial securities. Okay. So if you want to buy, for example, if you want to buy a bond, okay. So if you want to buy a bond, so you have to go to the market, okay. You have to go to the market. And when you go to the market, then you have to pay for the bond. When you pay for the bond, you have to pay through the bank, okay. You pay through the bank. And when you pay through the bank, you transfer through the bank or you pay money through the bank. So that is the financial institution. Okay. So that is the whole scenario. I will teach you in more detail when we go ahead in this chapter. Okay. So financial market includes the domestic market or international market. So would you like to buy the bond that is denominated in UK pound or that is denominated in US dollar? Okay. So if you want to buy the bond that is denominated in UK pound, that is our local currency, so you have to go to the domestic market. Okay. But if you want to buy that in the foreign currency, so that you have to go to the international market. Okay. So that further than this, domestic market is further divided into money market and the capital market. So money market includes only which market who deals in the money market instruments. Okay, money market means which market which deals in the money market instruments. Okay, and capital market means those market who deals in capital market instruments, and these instruments have a maturity. Okay, so after for example 3 year, 5 year, or 10 year, you have to pay back to the holder of the bond. If you money market and capital market divide the market according to the maturity. So for example, if your maturity is 10 year, okay, 10 year. So 10-year maturity, if this bond maturity is 10 year, if this maturity bond is 10 year, okay, so 10-year maturity bonds means above 7 year. Above 7 year bonds are categorized as capital market bond. Okay, so but less than 7 year, for example, if this maturity of the bond is 5 years, okay, 5 year. So this bond is called the money market instrument. Okay, so that is how the money market is categorized and the capital market is categorized and their instrument. Okay, so only those instruments who are short term and medium term will be dealt here, and all those instruments who have the maturity for the long term or above 7 years, that will be dealt in the capital market. Okay, and these markets are further divided into primary market and the secondary market. So primary market is where the initial market. This is the initial market. If a company wants to issue these shares, so that company has to issue the shares in the primary market, because primary market is where the IPO is released. IPO, initial public offer. Okay, so primary market is where the companies initially issue the shares. Okay, that is the primary. But after that, you know that shares don't have any maturity time. Okay, so the value of the shares will never be paid repaid by the company. So when it is not repaid by the company, so how can someone who wants to buy the shares of that company, so where can that person buy the shares of that company? After the initial issue, the shares are then traded into the secondary market. Okay, so secondary market. So the buyer who wants to buy the shares, now they can buy the shares from the secondary market. Okay, so that is the primary and secondary market bifurcation here. And the international market, it's same, but there is no primary and secondary market here. And that is the euro currency market, is where the short term and medium term instrument or securities dealt here. And the euro bond market is where the long term financial securities are dealt. Okay, and this is the whole topic we will going to discuss under the financial market. Okay, and the next is the financial institution. Financial institution is the intermediary that help you in doing any transaction. Okay, so role of the financial institution. What if you want to like pay anyone, so you can pay by the help of the bank. If you want to deposit money, so you can deposit the money into the bank, so your money will be safe. Okay, so that is the role of the financial intermediary. Another is disintermediation of fintech. Another is disintermediation and fintech. Fintech is payment banks, those who only don't have any physical branch, like payment banks who don't have no physical branch. Okay, no physical branch, so they don't have any physical branch, and they only operate through website or any app. Okay, and they don't charge any fees or very low fees, because they don't have any fixed obligation to pay the rent. So how to record the transaction? So how these fintech companies record the transaction? They record the transaction by using the blockchain technology. And how these traditional banks record the transaction? Double accounting bookkeeping. Okay, traditional banks use the double accounting bookkeeping, and these fintech companies use the blockchain technology. Okay, and in this blockchain, we have the initial coin offering and the security token offering. Initial coin offering is like Bitcoin. The Bitcoin is the initial coin offering, and the security token offering is realty. So this is the financial securities. I told you that this is the instrument. That is what you want to buy. Okay, what you want to buy. It's the bond security. Financial security is the bond, or I can say this is the product. Okay, this is the product, and this is the market, is the place intermediary who give you advice. Okay. So I already discussed money market instrument and the capital market instrument. It is for the short term and medium term. It is short term and medium term instrument, and capital market is the long term instrument. And the next we have the treasury function. Treasury function is the treasury department. So what is the treasury function? Treasury function means management of cash. Okay, and the treasury department is, further treasury function is divided into centralized or the decentralized. If you have a large company and you have so many branches, so you have one branch and you have so many other branches. Okay, you have this is head office. You have branch 1, branch 2, branch 3, branch 4. If you have the head office and there are so many branches, so you can either you can deal your cash at the head office. So you can have the treasury department, at the head office, that is called the centralized. That is called the centralized. When you have the treasury department at the head office, at only one office, that is called the centralized. But you have the head office at different branches, that is called the decentralized. So you have the treasury department here, you have another treasury department, another treasury department, and the treasury department. And these are the decentralized, decentralized, okay, decentralized. So these are the decentralized treasury department. So what is the advantage and disadvantage of centralized and decentralized treasury department? So we will study that in the detail when we will learn about this chapter. This term is an umbrella term that includes market institution, securities to facilitate economic growth. Okay. The structure of financial system includes, we already studied this. We have the financial market, financial institution, and the financial securities. In this, we have financial securities. These are the intermediaries. This is place, and this is the instrument. Okay, instrument, or you can say this is the product, what you want to buy. Okay, and this is the treasury function, how you manage the cash. How to manage cash. That is the role of the treasury function. So what the financial system do? Financial system channel the funds. Okay, so move capital from lenders to the borrowers. So let's understand this by using this diagram. So in an economy, at any point of time, there are people who have the surplus funds, and there are people who need money. Okay, there are people who needs fund. So you have the surplus funds, and there are some people who need money. So what the financial institution do? Financial institution. So financial institution take money from you and deposit your money into your bank account, and then give this money to another people who needs money. Okay, when you give money to the bank, when you invest, you will get a fixed percentage of interest in return of the amount you given to the bank. Okay, and in return, so for example, the bank is offering you 4% per annum interest on your deposit. Okay, on your deposit. But those who needs money, then bank give loan to those people and charge like 10% per annum interest. Okay, 10% per annum interest. So the difference between this is the 6%. So 6% is the difference, and this difference is the income for the financial institution. Who is the financial institution? The bank. So the financial system move capital, move fund or money from lenders who wants to invest to the borrowers who wants to borrow. Okay, payment mechanism. So if you deposit money in your bank account, so if you want to pay someone, so you can pay by your bank account. So that is another type of service that bank provide you. If you want to pay someone, you can pay by using the bank. Okay, so direct debit, and you can pay by check. Another is the create money and liquidity. Bank create money in increasing the lending. So bank make money, create money means income. Bank make money means bank earn money earn money by lending to the people at 10%, but they are only offering you 4% when you deposit. So 6% is the money the bank has created. So that is another function of the bank. Okay. So financial service provide insurance and pension facilities. So if you want to take the insurance of your car, of your bike, of your health. So for example, if you are paying the bank 1,000 for next 4,000 1,000 per annum, 1,000 per month for 30 years till 30. Okay. So after the 30 years, after when you reach 60, from 60, you will receive 2,000 per month, 2,000 GBP per month as a pension. So this facility is also provided by the bank. Okay. Next is the portfolio management. Portfolio management means bank help you to hedge the risk. Okay. So one is the best example. One of the best example of this facility is interest rate swap. Okay, interest rate swap. That is another kind of service that bank provide you to hedge the risk. Okay, has the risk rising in the interest rate risk. So that is the interest rate swap. Okay. So who are the participants in the security? A security is a generic term for medium of investment like share, corporate bond, money market instruments. So these are the financial securities, or I can say this financial instrument. So these are the financial securities, share, bond, money market instrument. So in this, if you want to buy share, so one is the buyer and one is the seller. So one is the buyer who buy the share, and the another person is the seller who wants to sell the shares. So the investors providing the finance. So if you want to invest, you will buy the share. Individual buying shares, and if you want to sell, so you will receive the money. So you will pay money when you buy, receive money when you sell. Okay. So you and the seller issue shares, and the buyer buy the shares. Okay. And this is another bank buying treasury bills and government issue bills. So treasury bills are the treasury bill is the bond or loan issued by government. If the government need money, if the government need finance, so the government will issue treasury bills. So government issue treasury bills, and then the government receive money, and you will receive the receipt of the treasury bill. Okay. Next, we have the financial market dynamics, surplus and deficit. Financial market act as a mechanism connecting buyers and sellers of the finance within the economy, household firms or government. So they connect buyers and sellers. So financial market connect the buyers and sellers. So there are different types of market. In the financial market, we have the different types of market. We have the capital market, that is long-term market. Long-term instruments are buying and selling here, and this is the short-term market or medium-term market, where the short and medium-term instruments are selling and buying here. And the another is the commodity market, derivative, insurance market, and foreign exchange market. So capital market consists of stock markets of shares and corporate bond. Okay, share, these shares are never repaid by the company, so they are the long term. So bonds, if the bond is issued more than the 7 years, so that is long term. Okay, long term financial instrument. So that is the capital market. So if you want to buy the shares or the bond, you have to go to the capital market. So if you want to buy any other short-term instrument like certificate of certificate of deposit or treasury bill issued by the government. So if you want to buy these things that is issued less than the 1 year, then you have to go to the money market. Another market, so if based on the which item, which product you want to buy, you have to go to the different market. So for example, if you want to buy the fruits, you have to go to the fruit market. If you want to buy the furniture, you have to go to the furniture market. That is the same here. So for the different product, we have the different market. So if you want to if you want to trade into the raw material like oil, metal, agriculture produce, then you have to go to the commodity market. So in the commodity market, you buy the oil, you buy the metal, you buy the agriculture produce, but you don't actually physically buy, you only buy it as online. You can buy it only in the online account. And when the price of that oil or metal increase, then you can sell that and you will make the profit. So that is the purpose of this market. Derivatives market. Derivative market is the risk management market. If you want to reduce the risk, so you have to go to the derivative market. So for example, if you are expecting that you will receive the $5,000 and you are also expecting that the dollar value will reduce and you will lose the money, so you have to go to the derivative market and do the risk management contract like options and futures contract. So that is the derivative market. If you want to reduce the risk, like reduce your currency depreciate or your interest rate will go up or down, so you want to reduce the risk, so you can reduce the risk by going to the derivative market. Another is the insurance market. Insurance market where you buy the insurance, facilitate the distribution of risk. You buy the insurance. So why you buy the insurance? Because you want to reduce the risk. You want to reduce the risk, or you want to transfer. You want to transfer the risk. Transfer the risk to insurance company. So what kind of risk you want to transfer? Like theft, theft of vehicle. So car insurance. Okay. Another is life insurance. Okay. So if you are died, then your family will be secure by getting the money from the insurance company. Okay, that is the life insurance. Another is health insurance. If you fall ill, then instead you will pay money to the hospital, the insurance company will pay on behalf of you to the hospital. So this type of risk you can transfer by buying the insurance. Okay. Another is the foreign exchange market, facilitate trading of foreign currency. Okay. If you want to buy the foreign currency, so you can buy that currency from the foreign exchange market. But remember, this is for the trading. So if you are expecting that the dollar value will rise in the next 6 months, so you will buy the dollar now, and then when the dollar exchange value will rise, then you sell that dollar and you will get the money and you will make your profit. So that is how where you can buy that foreign currency. You can buy that foreign currency from the foreign exchange market. Primary and secondary market. Like I told you that the financial market is divided into capital market and money market. And further, the capital market is divided into primary market and the secondary market. And the money market is also divided into primary market and the secondary market. Okay. So what is the primary market? Primary market is the new market, okay, new issue, where initially the shares or bonds are issued, and after that, if you want to sell your shares or bond, then you have to buy and sell in the secondary market. So primary market is the new market and the secondary market is the second hand market. Okay, so let's understand the primary and secondary market. Primary market is new issue, deals in the new issue of funds and provides the point, and it is the market, so it is the point where borrowers and the lenders meet. Okay, borrowers who want to borrow the money, lenders who want to invest the money. Okay, supply and demand forces find their most productive usage. So this supply and forces demand ensure that the funds and the share price will be determined. What is secondary market? Secondary market is the second-hand market, and this allow holders of financial claims to realize investment before maturity. Okay, so initially, if the shares are issued, then it will be issued as IPO. So if you want to buy the initial issue of the company, then you have to buy from primary market and there is no maturity. But if you want to sell that shares, you can sell in the secondary market. Okay, increase the willingness of surplus units to invest funds. So because the investors can sell anytime before the maturity, so this will increase their willingness to invest the funds. Okay, next is the reduce price volatility by ensuring smoother price changes through regular trading. So the financial market is regulated by the organization set up by government. Okay, like in India, the organization who manage the stock market, the financial market, is the SEBI. Okay, that is the SEBI. And this price reduce volatility by ensuring smooth price changes through regular trading. And what is the role of that organization, the SEBI? It ensures that price do not fluctuate too much. Okay, it ensures that the prices of the shares do not fluctuate very high and very low. Okay, so how does they ensure? if the price of any share fluctuate very high, increase very high in the day, so the SEBI will close the stock market, close the market for that share for that day, okay, on that day. So you cannot buy the shares on this day, on this day, the shares of that company. Next is the how the secondary market help investors achieve key end. So how the secondary market help the investors? Secondary market help investors by diversification. Okay, so if you want to invest by diversification, diversification means you invest in wide range of enterprise. So for example, if the shares of company A shares is increasing, but company B shares is reducing, is decreasing. If the company B shares is decreasing, but the company A share price is increasing, so that does mean, it means that you are diversifying your risk of loss. So you are losing money here, but you are gaining money here. So it means this is the diversification, spreading the risk of investing in wide range of enterprise. And risk shifting means choice of risk degree. Secured company loan stocks offer low risk, low return, but equities offer high risk, high return. It means that if you are risk taker, so you will buy the equity. If you are not a risk taker, so you can buy the loan note. Okay, so loan note is secured and equity is not secured. So if you don't want to take the risk, so you can buy the loan note or bond. But if you want to take the risk, you can buy the equity. So according to the risk, you can buy the instrument according to your requirement in the market. Next is the hedging, taking out counterbalancing contract to offset existing risk. Okay, so for example, the UK exporter is going to receive the euro. In future, the UK exporter is going to receive the euro, but he is also expecting that euro will fall, euro exchange value will fall in the future. So what he will do, he will sell the euro forward contract now, sell the euro forward contract to fix exchange rate. So this is the forward FRA, forward rate agreement. So you will do the forward rate agreement and you will fix the exchange rate against this fall in exchange rate. So this is the hedging. This is the risk hedging. So this means you can hedging means reduce or mitigate mitigate risk. It means reduce the risk. How you reduce? You buy forward rate agreement. Arbitrage is like every country has like 2 or 3 stock exchange. So so you can, like in India, you have the BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. Okay, so these are the 2 stock market. So BSE, Bombay Stock Exchange, and National Stock Exchange. So in UK, there might be different stock exchange and it can be more than one. Okay, so if the same company is selling, company A is selling share here as well, and here as well. Okay, so for example, the company A is selling the shares here at 10, but here the company is selling shares at 9. So what the investor will do, investor will buy the shares from NSE and they sell the shares here. So the difference is the profit. Difference is the profit. One is the profit. So this means that buying a security at lower price in one market, that is this, and simultaneously selling the same security at at higher price in the different market. But usually this price, is same. Usually this price is same, but this is the very rare situation. Okay, sometime it happen. Next is we have the sources of finance and market durations. Deficit units. Deficit units require different market. Deficit units means who wants the institution or people who wants money, so they require different market. So they need different market depending strictly on the duration of funds needed. So they want different market depend on the requirement of the time, how long, how they want the or depending on the time requirement, they need the market, different market. Okay, so division of sources of finance. So sources of finance divided into long term, medium term, and the short term. Long term is the equity, and equity can be from the retained earning or the ordinary shares. So retained earning is what? Retained earning is profit after tax. So let's take here PBIT and then interest and then profit before interest and tax. So I will PBIT, then I have the interest here, profit before tax, then the tax, then we have the profit after tax, and from that we can distribute as dividend. We can distribute this as dividend, or we can distribute this. Oh, sorry. After that, we have to pay the preference dividend. Preference dividend. After paying the preference dividend, we have the profit available to equity shareholders. So this profit is divided into, as we can distribute this profit as dividend, or we can retain this profit into the company. Okay, so this is the retained earning part, and this retained earning belongs to, this fund belongs to ordinary shareholders, equity holders. So this is the internally generated retained earning. Okay, so that profit, this is the profit part, but this is not distributed. If you have distributed, then that is called the dividend, internally generated retained earning, and that is another is the ordinary shares. And we have the medium term source of finance. We have the leasing. If we buy anything from on the lease agreement, like 4-year, 5-year lease agreement, then that is called the leasing. Okay, on the leasing means buying something, taking something on the rent. So you have to pay the monthly or yearly rent. So that is called the leasing. And that another is hire purchase, similar to the rent, okay, similar to leasing, rent. And we have the short-term sources of finance. Short-term sources of finance is like trade credit. Trade credit is debtors. Okay, so trade credit is trade payable. Trade payable means those people who trade payable means we have to pay to these parties within 1 year, but we have not yet paid. So we have to pay to these parties, these people in 1 year. So that finance is called the trade credit. Okay, if we buy something or bought goods on credit, when we bought goods on credit from suppliers. Okay, so that is the another form of finance, credit. So that is only for the 1 year. So it is the short term. And overdraft, when we take overdraft from the bank, so that is called the overdraft. Overdraft means you can withdraw more than your bank balance. When you withdraw more than your bank balance, then it is considered as overdraft. So these are the part of money market. And the capital market, you have the ordinary shares and the long-term ordinary shares and the long-term loan note. Ordinary shares, loan note, and the preference shares are the instruments that are traded in capital market. So these loan note, preference shares, and the shares are traded in capital market. And these leasing, hire purchase, credit overdraft, these are traded in money market, short term, medium term. Okay, special purpose. So this is another type of finance, but it is a special purpose and given by the government. So it is not considered, it is not traded in any market like money market or capital market. It is a grant that is given by the government. So what is considered as short term? Short term is up to 1 year. Okay, so like trade payable, or I can say the trade credit or overdraft. Okay, medium term is 1 to 7 years, like leasing, hire purchase, and the long term is more than 7 years, like shares and loan note. Shares never repaid by company to shareholder. So never repaid. So the principal amount is never repaid by the company to the shareholders. So there is no maturity. Okay, but these financial instruments have maturity date of up to 1 year, or this has the maturity date of 1 to 7 years. Okay, but this has the maturity date above 7 years or never, no maturity date. Okay, the financial market is further divided into money market and the capital market. So what is money market? So money market deals in those instruments, those securities which are less than 1 year. Okay, deals in short-term funds where transactions are conducted by phone or online. It is a network of closely connected markets. Okay, so what are the key participants in the money market? Participants are central bank and the commercial bank. Central bank is the main bank. Central bank is only one in a country, okay? But commercial bank, there can be more than one in a country. So, and this central bank manage the commercial banks. Okay. So central bank role is to manage the commercial banks. What is the finance house? Finance house provide the finance. Okay. So if you want to take the loan, so you can go to finance houses. Investment and unit trust, what is their role? Their role is that they collect money from you and they invest on behalf of you. Okay. So they collect money from you and then they invest the total amount in the stock market. And building societies are people who manage funds. So for example, five people made a fund that they will deposit certain amount in this fund, and if someone is required, if there is any need for the funds, and when someone need the money, then they take money from that fund and they charge very low interest like 1% or 2% per annum, okay, yearly interest. Instead, the bank charge very big amount of interest, that is around 8%, 10%, but these building societies only charge 1% interest or 2% interest from their members. Okay, so these are all the building societies. Local authorities and local companies. Local authorities are government and large companies, private individuals like us. And primary roles of money market. Roles of money market is liquidity, short-term. If you want to sell your certificate of deposit before maturity. So if you want to sell your certificate of deposit before maturity, so you can sell in the money market. So it provides the short-term liquidity. Trade finance. Trade finance means facilitating short-term trade credit provisions. Okay. So if you need short-term credit, trade finance, so this money market help you to get the trade finance. Risk management allow the organization to manage the exposure to foreign currency risk and interest rate risk. The capital market deals in long-term finance, mainly via stock exchange. So the capital market instruments like bond, preference share, and shares, ordinary shares. They are buy and sell on the stock exchange. So deals in long-term finance via the stock exchange. The major type of securities deal here is the public sector and foreign stock. And other securities are company securities like ordinary shares and the corporate bonds. So one another is the euro bonds. So euro bonds are what? Euro bonds are like bond, but they are denominated in currency other than the home currency. So if you are from the UK, so your currency is pound, but this euro bond is denominated in US dollar. So this is denominated in currency other than national currency of the country, international bonds. So this bond will create the known as the international bond. International financial market is is a market, an international financial market exists where domestic funds are supplied to foreign users. Okay, so domestic funds now supply to the foreign users and the foreign funds supplied to the domestic users. Okay, so for example, this is the international financial market. So this is the domestic fund that is supplied, and the foreign funds is coming the financial market. Okay, so in international market where domestic funds are supplied the foreign user, and this fund will then be taken by the foreign user, and this fund is then taken by the this domestic fund is then taken by the foreign user, and this foreign fund is then taken by the domestic user. Okay, currency need not to be either of the lender or the borrower. So the amount he deposits, so if he is from UK, but he will deposit in the US dollar. Okay, if he is from USA, he will deposit in the UK pound or any other currency like yen, Japanese yen. Okay, so money deposited with a bank outside its country of origin. So you deposit money with the bank which is outside of your country. Okay, so money deposited with a bank outside of its country of origin. So you deposited money outside of your country in a bank. So that is bank is, and the currency is the US dollar in a London bank. So this is the London bank, and you deposited the US dollar in the London bank. Okay, generally you deposit pound, but you deposit the London bank. That is, now this instrument is called the euro dollar. Okay, euro dollar, like euro bond and euro currency. This is the currency. So you say that it is a euro dollar. Okay, which currency you deposited? The dollar. If you deposited the rupee, then it is euro rupee. Okay, deposits need not be with European banks. So euro does not mean that the deposit must be done with the European bank. Okay, so euro does not mean it must be deposited with European bank, or it is euro. Okay, euro does not mean European or euro. Okay, and once you deposit that amount in that bank, then banks use that amount and lend it to another users, and that lending is called the euro market. Okay, euro market, and this euro market is divided into two parts, and there are some active centers. The euro market is located in London, New York, Tokyo, Singapore, Bahrain. Okay, so these are the locations where euro market is located. So euro currency deals in short-term and medium-term instruments, and the euro bond means long-term instruments. Okay, so available for entities with excellent credit rating, large sum of deposit and borrow. But it is available if you want to borrow from the euro currency market. So you have to be you have a good credit rating. You have a good credit rating, and you must borrow a large amount. Okay, if you are borrowing a small amount, so you cannot borrow from euro currency. If you don't have the good credit credit rating, so you cannot borrow from the euro currency. Okay, and straight term deposit, fixed maturity, and if you want to deposit, that deposit must be very big amount, large amount. Okay, straight term deposit, fixed maturity interest, early payment penalties, and there are in the fixed term deposit. If you want to deposit in the euro currency market, so you have to deposit for the fixed timing, for the fixed year. So 1 year, 2 year. And in that, if you are depositing for the 1 year, so you cannot withdraw. No withdraw. You cannot withdraw money. Okay. If you want to withdraw, so you have to pay the penalty. And on that deposit, you will get the fixed interest. Okay. Certificate of deposit is negotiable active secondary market access. Okay. So certificate of deposit is the certificate that is issued for the deposits. If you made any deposit with the bank, then certificate of deposit will be issued. Okay, so that is negotiable. So you can sell that certificate of deposit and you can redeem the value. You can get the value of that deposit value. Active secondary market, and there is also the secondary market, which means that you can sell the certificate of deposit. Loans, bank loan, lines of credit, revolving loans. So bank loan, bank loan, line of credit, and revolving loan. Okay. So these are the euro currency instruments. So euro currency instrument is bank loan, line of credit, and revolving loans. And in the euro bond is generally for the long term, and the timing is 3 to 20 years, issued in several countries at once. Okay, issued by a syndicate of international bank. Syndicate means a group. So euro bond is like a bond, is like a loan. Okay, is like a loan or debt, which is issued by large group of international banks, which is denominated in foreign currency, which means that if you are in UK, so that must be in US dollar or Japanese yen or Chinese yuan, for example. Okay. Let's deep dive into euro currency and euro bond market. So euro currency features, deposit terms vary from, so you can, in the euro currency market, you can deposit from 1 night to 5 years. Okay. And currency cocktail depositors can take diversified positions. Okay. So you can take diversified position like special drawing, right? USD, yen, euro, sterling. So depositors can take diversified positions. So you can either buy USD, yen, or euro. So there are so many currencies, and you can choose if this currency is falling. So you can diversify your risk by using buying the another currency. Okay. Loan structure includes line of credit like overdraft and revolving commitments, series of short-term loans with regular interest review. Loan structure means you can take different types of loan like overdraft. So when you take that loan, so you can, when you take that amount, you have to return it to the bank after 1 month. Okay. And the another is revolving commitment. When you take that loan, you have to pay the amount every month. Okay. So these type of loans, two different types of loan here. So another is the participant, mostly interbank and the government, interbank, the government, local authorities, and multinational companies. So these are the big organizations. So they have the good credit rating, and they need the amount in a very, if they want to borrow, they also borrow the in very large amount. If they want to deposit, they also deposit the amount in a very big amount. So the banks are very big organizations. Government also has lots of money, and the MNCs company. Okay, and you know that one of the requirement is the good credit rating. So good credit rating. The banks, government, and MNCs already also have the good credit rating. So they buy from the euro currency market. They can buy from the euro currency market. They can borrow from the euro currency market because they have the good credit rating. So these are the participants and the large transactions. Okay. Euro bond market features. Euro bond market features are issuance, simultaneous multi-currency issue, privately placed or quoted on stock exchange. So when you have the euro currency market, when you have the what is the features of euro bond market? The issuance. So simultaneously multi-country issue. So you can issue the bonds in different currency, okay, in the different currency and in different country. Privately placed, these euro bonds can be uh, can be sold using investment banks. So which means that privately placed means you sold these to the one organization. When you quote these on the stock exchange, which means you sell these to the public instead of selling to the one organization. Okay. Another is the flexibility, can be fixed or floating rate. So the euro bond rate can be fixed or the floating rate. And variants, convertible and options. So it can be convertible, like similar to domestic convertibles. So these bonds can be converted into the different instrument like shares. You can convert these bonds into shares. Okay. Option holder can switch currencies for repayment and interest. So you have also the option to if you borrow in US dollar, so you can pay in yen or pound. So this is the option. You can borrow in different currency, but you can pay in the different currency. Okay. Next is the borrowers. Borrowers are the large companies, World Bank, European Commissions. So who buy the euro bonds? Euro bonds are bought by the large companies. So these are the big companies who buy. World Bank is another big organization, and the European Commission is another big organization. Okay, so these currencies can be US dollar. These euro bonds can be issued in US dollar, euro, Swiss francs, and GBP. Stock market and corporate bond market. So what do you mean by stock market? So stock market means a market. Okay, so if you want to raise money, okay, if you want to raise funds, so where will you go? You go to the stock market, okay, and you go to stock market if you want to raise money, if you want to raise funds, you go to stock market. Okay, so how do you raise funds? You raise funds by issuing shares, bond. Okay, so your company, if your company needs fund, so he will go to stock market and he will issue the Okay, stock market and corporate bond market. So if your company wants to raise money, if your company wants to raise funds, so the company will go to stock market and issue shares, bond, and that shares and bond will be bought by, these are bought by investors. Okay, so you will get the funds. So stock market is stock exchange optimized nationwide resource distribution by valuing securities fairly and providing continuous liquidity. Fairly means value, value, value securities, value price of security, and liquidity means can buy or sell securities in the stock market. So what is the role of stock market? The role of stock market is facilitate trade in shares, bond, government bond, local authorities. Okay, so the bonds are issued by these company and the government, and this can be buy and sold. These shares and the bonds are bought and sold by the stock market. So, and next is the allocate capital to industry. So these highly valued companies can raise fresh capital easily at low cost. Okay, so if your company wants to raise funds, so these companies can raise funds from the stock market. And if your company is reputed company, so your company can easily sell the shares to the public, because your company is a reputed company. So people wants to buy shares of your company. Next is determine a fair value of traded assets. Determine a fair value of traded assets, and this is one of the job of the stock market, is that it determine the price of the securities, that is determined by the demand and supply. If the demand is high and the supply is not sufficient, so the price will go up. Okay, so these type of things by which the price is determined. Speculative trading on the market can be assisted by smoothing price fluctuations and ensuring shares are readily marketable. Okay, so stock market also help you to speculate the speculative trading. If you are expecting that the share price will go up, so you will buy the shares, and after a few months you can sell the shares and then you make the profit. Okay, so this type of things can also be done in the stock market. So even you can buy the shares for 1 day or 1 week. Okay, because of the speculative trading facility provided by the stock market. So a country can have more than one stock market, like London Stock Exchange, and there is another stock exchange in the UK, that is AIM, alternative investment market. And this London Stock Exchange is for the big companies, but alternative stock market, alternative. But this alternative investment market is for the small companies, and OFX is trade via specialist brokers. Okay. trading mechanism and market makers. Investors contact a broker to trade trading mechanics and market makers. Investors contact a broker, trading mechanics and market makers. So next topic is the so let's move on to the next trading mechanics and the market makers. Investors contact a broker to trade. So if you want to buy the shares bond, so you have to go to the broker. Okay, so broker will tell you the price of that securities and the features, how many days, how many months you have after which you can uh, get the maturity value and all of these things. So broker will provide you the facilities like the analysis of that stock, bond, or anything like this. Okay. So another next topic is trading mechanism and market makers. So if you want to buy the shares from the stock market, so you have to go to the broker. So when you go to the broker, you will buy the shares and the seller will sell the shares to the broker, and this transaction is done by the broker. And another is the market maker. Market maker means they hold large large amount of shares. They hold the large amount of shares. Okay, so they hold the large amount of shares. So they quote the price. So they quote the buy and sell price. So because they have the large amount of shares, so they always buy. They always quote the at what price we will buy and at what price we will sell the shares. So this quote is done by the market maker, and the broker will buy the shares from the market maker because they have the large amount of shares of a company, and other people don't have the shares. So the broker will buy from the market maker, and then this will be sold to you. The difference is the profit. Okay, difference is the profit or income for the market. Financial intermediary. If you want to lend or borrow, so there are three options available. So first one is the direct contact. Second one is the organized financial market, and third one is the financial intermediary, financial institution. Okay, so the direct contact is very rare. So you have to go to the person that wants to. If you want to borrow, okay, so you have to go. You have to go to someone. You have to find someone who wants to land. But how can you find? Will you go on the road and ask everyone that can you lend me some money? Can you lend me some money? So I think this is not possible, because if someone don't know about you, they not gonna lend you any single amount of money. Okay, so that's why it's very rare. And when you go onto the streets and ask people, that is also another cost, your time, your conveyance, the transportation cost. Okay, so this is very high cost. So it is not possible. Another is the risk of default, because you are borrowing from someone. So the other person might think that you will not pay that person in the future. You borrow, but you don't pay in the future to that person. So that is another risk. Okay. Next is the financial market. So if you want to borrow, so you can go to the financial market like stock market, and where where you can issue the bond, or the share. Okay, so when you issue the bond or share, then the investors will invest in your shares or bond, and you will get your money. Okay, so individual buy bonds can sell to other investors before redemption date. Okay, so that is also another option. Next is financial institution as intermediary. Lenders obtain a non-tradable asset like bank deposit, and the borrower gets the loan. Okay, so here is how can you get the money from the financial institution. So financial institution is like bank. Okay, so those who have surplus funds. So for example, this person has surplus funds, so this person will invest in the bank. Okay, and the bank will further lend this money to another person. Okay, and when you give your money to the bank will give you the certificate of deposit. Okay, certificate of deposit, and on that amount you will get the fixed interest. Okay, so that is how the process works, and bank will further lend to another person, and this bank is working as an intermediary between you and the lender. Okay, financial intermediation is the process whereby potential borrowers are brought together with potential lenders. Okay, so intermediation is the process where borrowers and lenders come together by the help of intermediary. Okay, intermediary. So what is the role of intermediary? Role of intermediary is risk reduction. Okay, so you know that there is a risk. If you contact direct, if you do direct contact, then the other person, the person who is taking your money is may not give you, may not return your money. Okay, may not return your money. So this is the risk. But here, when you give money to the bank and bank lend money to the other person, then bank has a very big network. Bank also hire some person who like recovery agent. Okay, so if you don't pay money to the bank, then bank will send you the recovery agent at your home. Okay, so your risk will be reduced. Okay, lending to a variety of entities reduce risk with single default causing total loss. Okay, it means that bank will take your money and lend to different people. So all the people at once don't default. Okay, only 1% or 2% will default, but bank will lend to different persons. So this is the risk reduction. Okay, aggregation means you are not the single person here. There are so many people who have surplus funds right now, and they are giving their surplus funds to the bank. Okay, they are giving surplus funds to the bank. So for example, you are given 2000 pound, the another person gave 4,000 pound, another person gave 1,000 pound. Okay, so the total is 7,000 pound. Okay, 7,000 pound, and this 7,000 pound will be then distributed, will be then given, or you can lend this 7,000 to different persons. Okay, different persons. So this means that pooling small deposit and make large advance to individuals. So if someone want 7,000 pound, so bank will lend the 7,000 pound, because the aggregation, they are aggregating the money. Okay, another is the maturity transformation. Maturity transformation means bridging the gap between borrowers who wants long term and the savers who want short term via floating pool of deposit. So generally the borrowers wants to borrow at the longer term, but savers wants to only deposit for the short term. Okay, so this will so bank what the bank will do, bank will analyze that who wants to deposit for how much time. So if for example you are going to deposit for 1 year, another person is going to deposit for 2 year, okay, another person is going to deposit for 3 year, okay, then bank will analyze that the average amount I will stay for this is around 2 year. So bank will then give this amount for the longer term to the another person, okay, another person. So this is called the maturity transformation. You are only giving for 1 year, but the bank lend the money for the year to another person. So that is maturity transformation. Liquidity. Liquidity means aggregation, and maturity transformation means cash can be sourced, or invested quickly. If you know that your money will have, when you give money to the bank, so your risk will be reduced, and when you give money to the bank, and this bank will aggregate your money, because you cannot lend 1000 to 1000, it is very small amount, so you cannot lend someone 1000 because someone wants 5000, so you cannot lend. But you know that when the bank aggregate, so bank can lend the money. So what will you do? You give your money to the bank. So that's why it's very easy for the bank. When the customers get to know that their risk will be reduced, the bank will aggregate the amount and then lend. And the maturity transformation, when the surplus fund investors get to know these, then they will invest, they will give money to the bank. So this will increase the liquidity, and also they give money to the bank, and also when they want their money back, they can easily get their money back after whenever they want their money back. Okay, so whenever they need money, so they can get back their money from the bank. So that's why it's very easy for them to get their money. Okay, liquidity. Another is the hedging. So the one of the role of intermediary is to reduce the risk, providing products like forward future options to reduce risk exposures. So these are the derivatives. So how can you reduce the risk? By using the derivatives. Okay, so forward, future, and options, these are the derivatives. So bank provide these kind of instruments for risk reduction. So types of financial intermediaries. So we have the different types of intermediaries. First, we have the clearing bank. Clearing bank means big bank, high street banks. These are the big banks, okay? And the another is the investment merchant banks. Merchant banks are those who provide you the financial advice, where you can invest, okay? Finance. If you want finance, so they can provide the finance, like underwriting. Okay. So if you could not sell your shares, you can go to the investment banker and say that I could not sell my shares in the stock market. So can you do underwriting of my shares? So this type of services is also provided by the investment banks. facilitate foreign trade. If you want to do foreign trade, that is also provided by the investment banks. Okay. Insurance companies, what the insurance companies do? Insurance companies take the insurance premium from you. They take the insurance premium from you, and then what they do? They invest that amount in stock market, in any like fixed deposit or bond shares. They deposit that amount, they invest that amount, and when you have the like when you have the health problem, if you taken the car insurance, okay, and if the your car had an accident, so you can claim the insurance. So you can claim the insurance. So first you pay the premium, but after you have the accident, so you can claim your insurance. Okay, that is the purpose of insurance companies. But what they do, their money, when they receive the money, when they receive the insurance premium, they invest this premium, okay, and they earn some money. And after that, if sometime some customers face the accidental or some type of situations, so they can claim their insurance. Okay. Another is the finance companies. Finance companies provide finance. Okay. Provide finance. So finance houses, medium term credit, leasing companies. Okay. So lease capital to the business and factor debt collection finance. Okay. So they collect debtors money on behalf of you. Okay. On behalf of you, debt collection. Investment and unit trust companies, what they do, they collect funds from large number of people. They collect funds from large number of people, and then what they do, they invest, and then they invest or trade in the shares and bond, because they hire the qualified finance professionals, because the investment and unit trust companies hire the qualified finance professionals, so they have the good knowledge of where to invest, how to invest. Okay. So they collect money from the general public and invest the large amount of money in the shares, bonds. Okay. So this is the role of finance, investment and unit trust intermediary. So they are collecting money and then investing on behalf of you. Okay. Pension funds, they collect contribution. They collect what the pension fund companies do. Pension companies do, they collect the contribution till the age of 60. You pay the contribution to the pension companies, and after the retirement, after 60 years of age, you will receive the pension. You receive a fixed monthly income from the pension companies. So that is the pension contribution. So when they receive the pension contribution, they invest that pension into the share market or stock market or anywhere in the project that give them high return. Okay. So after that they give you the pension. Okay. So saving banks, what is the role of saving bank? Saving bank collect money and lend money. Okay. Collect or you collect or deposit money into the saving bank, and the saving bank will lend this money to the other people. So that is the saving bank role. Okay, national saving for small investors. So this saving bank act as a intermediary. Building societies are similar to clearing banks. So these are big banks, but this is only for the domestic customers. Okay. What is traditionally happen? So traditionally it's that when you want to invest or you want to borrow, so you have to go to the bank to deposit your money, or when you borrow, so you have to go to bank to borrow. Okay. But also the when you invest, you have to, if you want to invest in the financial market, so you have to register with a broker, that is a stock broker. And if you want to borrow, that company must go to the financial markets through the stock broker. But what is this is the traditional process. But what is happening in the new process, that is called the disintermediation. Disintermediation means traditionally you need broker, okay, traditionally. But in the disintermediations, you don't need any intermediary, okay, you don't need any intermediary. So how this can happen? This can only happen using this technology, financial technology, that is called the fintech. Because of fintech, disintermediation means because of the fintech technology, you don't need any broker or bank that give you this type of service. Okay. So the fintech is the innovation that modernize the provisions of service, aiming to disrupt the traditional market. Okay. Innovation. Fintech is the innovation. Okay. Fintech is the innovation, which is the, and that innovation modernize the service. Okay, that modernize the service. And the aim of this fintech is to stop the traditional market from growing. This fintech will stop the traditional market from growing. Okay, so that is the main role of this fintech. The In the next line, it is written that traditional banks have been slow to adopt modern technology. Yes, traditional banks are very slow in adopting the technology, but leaving a market gap for fintech business, and this makes the market gap. Okay, this makes the market gap for the companies who can easily adopt the new technology. And this means that fintech businesses, financial technology business, use mobile apps. Okay, these companies fintech companies use mobile apps and secure platforms like blockchain for the modernization of financial technology. So one of the example is payment bank, payment banks. Okay, so there is no branch of these banks. There is no physical branch. Okay, no physical branch. Trade through mobile app, and website. Okay, so that is one of the fintech example that make the traditional banks old school, and the payment bank is now growing, and they, because they don't have any physical branch, so they don't charge any annual fees or anything for that kind of service. Okay, so they are very cheap and very affordable. Next is disintermediation, is the reduction in the use of financial intermediary. Disintermediation means the reduction of intermediary, reduction of the broker, which means that bypassing a bank, you don't need any bank, physical bank like payment bank. So you don't need the bank anymore. And another is the removing the broker in borrowing and lending. How can you remove the broker in borrowing and lending? P2P, person to person. So there are some apps who can lend money to the person. If you are an individual, so you can also lend money to an individual, and you can earn higher interest on that lending. Okay, so this example is also here. P2P lending companies and risk insight. Fintech technology is one of the example of P2P, person to person lending companies. So instead of going to deposit deposit money deposit money into the bank deposit money into the bank, and then bank will lend your money to another person. Okay, this is the traditional method. Instead, what the P2P lending companies do, they take your money and give it to the person. Okay, so there is no need of bank. In this process. So this means you are lending the real person. High default risk, because these people don't have any high credit rating, or they don't have any history of taking loans. So there is high default risk. Risk is that these people will not pay your money. Okay, so this will reduce your confidence. This will reduce your confidence. Like UK P2P lender lending entered administration in 2019 with 19 million in default. 19 million. So can you guess how big is the default? Okay, so the big risk in this kind of P2P lending is that there is high default risk. Next, we have the blockchain technology. So these fintech companies use the blockchain technologies. Usually, the traditional methods, they use the bookkeeping, double entry, bookkeeping. But these fintech companies now using the blockchain technology for recording the transaction. Okay, so what is blockchain? A chain is like this. Okay, the chain is like this. One block is connected to another. So this is called the blockchain. And this is a decentralized, distributed, and public digital ledger. And these are the ledger. Okay, and these ledgers are used to record the transaction across many computers. And these transactions are recorded in these ledgers. Okay, and these ledgers are recorded among different computers. Okay. So this transaction is recorded here. So recorded across many computers. Okay, this transaction, single transaction. So which means that collective bookkeeping provide an open public record keeping mechanism. Okay, which means that collective bookkeeping means here one person is recording, here another person is recording the same transaction, and this another person is recording the same transaction. So this is called the collective bookkeeping. Security consensus. Records cannot be retrospectively altered without network consent. So if you want to change something here, in this ledger, so you have to take the consent of this. Okay. So fraud prevention discrepancies in one ledger are instantly rejected by another. So because these are connected with one another, so these are connected with one another. So if there is any error in this, so the another you will find the error in the next segment as well, in this segment as well, in this segment as well. So any discrepancy in any ledger can be identified among the different another ledger as well. Okay, so this entry will be rejected. Okay, so this entry will be rejected, and you will can easily find that this ledger is incorrect. Financial inclusion provides financial services to unbanked. It means that those people who don't have the banks, now they can use the banks like payment bank. Okay, so payment bank are online bank. So you don't need. So when they get to know that their record is very secure, their record keeping their bank balance is recorded in the safe transaction and different computers. So they are very happy to know that the security is very high. So they will definitely use the banking service. So which means that those people who never tried the banking, now they will try to use the banking. Adults without bank accounts. Okay. So this is another different topic, that is token offering, which means that if you want to borrow money, okay, if you want to borrow money, so you can give the token. Okay, you can give the token. You take money and you give the token as a receipt. Okay. So if you want to borrow, so here you will give what? Here you will give the Bitcoin. Here you will give the Bitcoin. Here you will give the token. Here you will give the token. Here you will give the coin. Okay. One of the example initial coin offering is Bitcoin. And I think so many people know about this. It's very popular in the past 1 decade. And Bitcoin use the blockchain technology for their transaction. And why the companies offer this initial coin? So it means that if you want to borrow money for any specific project, okay, so you have to provide access to new technology or service, less fixed value. Okay, so if you want to borrow money for that project, so you will issue the Bitcoin, okay, and you will take the cash. Another next is the lower regulation. So high risk. So because the blockchain technology is not regulated now, still it is not regulated in many countries. So these lower regulation may create some problem, like government may ban that technology. So that's why it is a risky technology. So you may lose your money if you take the Bitcoin and next day the government ban the Bitcoin. So that's why you may lose your money. So used primarily for rapid project funding. This is usually this is used for rapid funding. You want to quick funding, so you can issue the Bitcoin and then you can take money. Okay. That's one. Another is the security token offering. This means that instead of issuing the Bitcoin, you issue the token, and that token has backed back backed by value of asset. Okay, and this backed by the value of asset, backed by backed by value of asset. So this asset can be any asset, like anything I'm taking the example of buildings here. So like real estate. Okay. So one of the security token is that one of the example is realty. Realty is the security token that is issued by a US company that is backed by the value of the real estate. Okay. So they tied to the real monetary value says that or it can be the value of that token can be derived instead of the real estate. This token value can be derived from shares, debt, or any tangible property. Okay, highly regulated. This token offering is highly regulated in countries in especially in US. So that is very less subject to scam. Okay, attractive to risk conscious investors. So those investors who don't want to take risk, so they can go for the security token offering instead of the initial coin offering. Money market instruments are the financial securities who are traded in money market. And money market is that market where the short-term instrument and the medium-term instrument are traded. Short-term means less than 1 year, okay? And the medium-term means 1 year to 7 year. Okay, so that is medium-term. Coupon bearing securities means that this coupon denotes that a fixed percentage. Coupon means a fixed percentage that will be given to the lender at the quarterly, yearly, or monthly. Okay, as a interest. So fixed maturity and specified interest rate. So interest rate is specified and there is a maturity date also specified. That is called the coupon bearing securities. And in the coupon bearing securities, we have the two types of securities. First one is the certificate of deposit. Certificate of deposit is the evidence of the bank deposit that you have deposited your amount in the bank. Okay, so that is called the fixed deposit, also you known as the fixed deposit. Or here we can say this as certificate of deposit. And this certificate of deposit is fully negotiable. It means that you can when you deposit that amount and you receive the certificate, then you can transfer the certificate to another person and discount that and get your money. So you can instant liquidity, and if you want to break that certificate of deposit, you can break that certificate of deposit and you will get your money. And you have a fixed interest. There is fixed interest that will be paid on that securities. And next is the repo, sale and repurchase. Sale and repurchase means you are selling the security. Right now you are selling the securities like bank and treasury bills. So these securities you are selling and you are getting the money. But after some time you will buy back. You will buy back these securities at higher rate, higher price. Okay, so you are selling this at 10, but you will buy back at 15. So difference is like the interest that you earn. Okay, that the lender earns. So this is the income for the lender. So you sell the securities, then at the lower price, then you bought it back at the higher price. Next is the discount securities. These securities are issued at discount. Okay, and this will be discount to maturity value. Issued at discount to maturity value, no interest paid. Reward is capital gain. Okay. So these are issued at discount, but there is no interest paid because it is issued at discount, and redeemed at face value. Okay, redeemed at face value. If it is issued at 90, so for example, the face value is 100, so it will be redeemed at 100. 10 GBP. So 10 GBP is the difference. That is the interest, or you can say the income for the lender. And reward is the capital gain, that is also called, you can say that is the capital gain. Okay, so treasury bills, government issued by central bank. So treasury bills means this is issued by the government. Treasury means government, and these are issued by the government via the central bank. The central bank is the main bank, only one bank that who control the all other commercial banks. Okay. So these treasury bills are issued for the maturity period between 1 to 3 months. Okay, so that's why it is the sort of money market instrument. And the commercial bank is same like treasury bills, but it is issued by the companies. It is issued by the companies. Here it is issued by the government, but here it is issued by the companies. Okay, corporations. Large corp issue the commercial paper. So, for example, this is the company. Okay, this is the company, and this company wants to issue the commercial paper. So this is the investor. So this company will issue the commercial paper to this lender. Okay, so this is the lender. This is the company. Okay, and if you want to issue the commercial paper, so you have to be good credit rating, which means that how many times you issued the commercial paper and you repaid the amount to the lenders. Okay, how many times you take money from the lenders, and have you repaid that amount to the investors after the maturity. So this based upon that, the credit rating is defined. So like A plus, okay, and B, triple B. So these kind of ratings that are given by the agencies that who wants to issue the commercial paper. And when you have the good credit rating, then the lenders will know that you are a good company, and you return the money to the lenders or the investors. So they will lend you the money. Okay. So that is called the commercial paper, and there is no security deposit. So bank, when the bank issue commercial paper and take the money from the investors, lenders, so the bank don't need, sorry, the company, not the bank. So the company don't need to deposit any kind of securities for that issuing the commercial paper. Okay. So because of the credit rating, these investors give the company money. So there is no need of deposit of the security by the company. And when you issue these type of commercial paper, these dates are between 7 to 45 days, and this is generally useful for working capital finance. So this is mainly used for working capital finance because the term is very short. So that's why it is used for working capital finance. Okay, so high issue costs. So these finances, if a company wants to issue, so you have to do lots of paperwork and the administration work to issue that kind of commercial paper. So there is high cost for that, and this is suitable for the large amount, because if you are spending money for issuing the commercial paper, so you should try to grab the large amount. Okay. Next is the commercial acceptance. Sorry, next is the banker acceptance. Banker acceptance is payment backed by a bank that eliminates transaction related risk for both importer and exporter. So if this person is the exporter, okay, and this person is the importer, okay. So when you send goods, this is the exporter, this is the importer, okay. You send the goods to the importer, and the importer will send you the money, okay. But the importer don't trust you because you live in the different countries. So that is where the that instrument is used, the money market instrument. That is the banker acceptance. In between, there is one middleman. That is the bank. That is the bank here. So there is the bank here. That is the middleman. That you tell your bank that issue the banker acceptance to the exporter. So when you issue the banker's acceptance, then the bank will take the responsibility that after receiving the money from after receiving the goods from the exporter, I will transfer you the money. So that is called the banker's acceptance. Okay. So payment backed by a bank that eliminates transaction related risk, both importer and the exporter. So it is generally used in the import and export, but you can use in another transactions as well. Next is the derivatives. Derivatives, these are the instruments are used to reduce the risk. So if you want to reduce the risk, like increase in the interest rate or decrease in the interest rate, increase in the foreign currency or decrease in the foreign exchange value. So if, for example, you are going to receive the money after 3 years, 6 months, so you are expecting that the foreign exchange that in the dollar the dollar amount that you will receive in the future will go down, that the dollar value will go down. So that is the risk. So that risk you want to reduce. So how can you reduce that risk? So you can reduce that risk by using the derivatives. Okay, derivatives are the instruments. So these are value derivatives means the value derived from underlying assets. So these underlying assets are like commodities, shares, bond, and interest rates. Okay. So these are the derivatives with whose value are derived from these. It can be share, bond, and interest rates or commodity. And the one of the derivative is the forward rate agreement, and this derivative is the OTC or the counter. So you have to go to the bank. You have to go to the bank, and you can agree the forward rate agreement. So you will do a agreement for the exchange rate, that this exchange rate will be fixed for the future, and you will your money, when you receive the foreign currency, your money will be exchanged at that fixed exchange rate instead of the market rate. Okay, so that is the forward rate agreement. And next is the future option swaps, and these are the other instruments. So for that, you have to go to stock market, and the swap can be done by the bank here, and this is the over the counter. And what are these futures and options? These are very very difficult to teach you here. So I already teach you in the another chapter, that is the foreign currency exchange and the interest rate risk. So in those chapters, I taught you these, what is the futures, options, and the swaps. So just remember that these are the derivatives, and these are used to reduce the risk. Okay, and their value is derived from the underlying assets. So next is the capital market. So capital market instruments. Capital market means you have the maturity timing. Maturity time is 7. Maturity time is more than 7 years. Okay, more than 7 years. So if the maturity value of the instrument is more than 7 years, then it is traded in the capital market and is known as the capital market instrument. Okay, so what are these capital market instruments? Capital market instruments are like ordinary shares. So their value, their maturity value, payment obligations. So their value are maturity. Okay, this is the maturity, so never paid. Okay, never prepaid. Okay, unless redeemable. Only if you have the redeemable preference share, then the principal amount, then the value of the preference shares will be redeemed. Otherwise, there is no responsibility that you have to repay the preference shares amount to their holders. And in the corporate bond, you have to pay you have to pay to the bondholders the amount that he or she deposited. For example, he deposited 1,000, so you have to return that amount after after say, for example, 10 years. So, and these bonds must have the maturity value more than 7 years to be categorized here as the capital market instrument. Let's see the difference. What are the difference between these? The first difference is between the ordinary share, preference share, and the corporate bond is that ordinary shares are the equity. Ordinary shares are the equity, and this is the nature of that share. Equity means they are the owners. Okay, and preference shares have the hybrid nature. It means they have the characteristics of equity and the debt. Okay, and bond is the pure debt. Debt is like loan. When you take money, you have to return that money after few years, after 10 years, 7 years. So after that you have to return that amount, principal amount, plus the return, plus the interest. So you have to repay the principal plus the interest after 10 years, for example. 10 years. Okay. So that is the pure debt or loan. Okay. Next is investor role. What is the investor's role? So these investors are the owner. And next is the preference share. Preference shares, these are the company owners with fixed priority. Company owners with fixed priority. So they are also owner, but they have only the fixed priority. Fixed priority is given, not wholly, not wholly the owner. Sometimes only in few matters. Only in few matters they are the owner, but they are not the owner always. Okay. So lenders or creditors, so they are not the owners, they are the lenders. Okay, or creditor. And the type of return, so they get the dividend. Okay, they also get the dividend, preference shareholders, but their dividend is variable. Variable means if you only have profit, only have the profit available to equity shares. Only if you have the profit available to equity shares, then you can distribute. Otherwise, there is no need to give any kind of dividend. Okay. But here the dividend, you have the fixed percentage of dividend, and you have to give the dividend if you earn the profit. So you have to give it dividend to the preference shareholders before the equity shareholders. And here the bondholders will get the fixed interest rate. So for example, they have given you the £1,000. Okay, so you have to give them the 8%. I'm assuming here, so you have to give the £80 as a interest, and that £80 is fixed for the upcoming years. Next is payment obligation discretionary if declared by the board. If it is declared by the board, so then only you can pay the dividend. Otherwise, there is no need. Discretionary must be paid before ordinary dividends. It is also discretionary, but you have to pay that before the ordinary share. If you want to pay the dividend, pay the preference shares. This has the preferential right before before ordinary shares. Okay. So which means that if you want to pay the dividend, so you have to first pay the dividend to the preference shareholders, then you have to pay the dividend to the equity ordinary shareholders. So I can draw one diagram here that is like PBIT, okay, and this is here. So now you have to pay the interest, that is the bond holders, and that is the fixed. You have to pay, either you earn profit or not, you have to pay the interest to the bond holders, and then you have to deduct the tax, that is the tax. Okay, and sorry, will then have here PBT, profit before tax. Then you have the tax, you have to deduct the tax. Then you have the profit after tax, Then you have the preference dividend, and profit available ordinary shares, profit available to ordinary shares. So you have to pay that profit. This is the profit available. Then you have to pay the dividend. So this is the dividend to ordinary shareholders. Okay, ordinary shares. So now you can understand that this is the bond. You have to pay the bond holders the interest first. Then you have to pay the dividend to the preference shareholders. Then you have to pay the ordinary shares to the ordinary shareholders after paying the preference shareholders. Okay. Payment obligation is mandatory, and that is the contractual duty even if company is in loss. So you have to pay the interest even if you are in the loss. Okay. Voting right, you have the ordinary shareholders are the owners, and they have the voting right, so they can interfere. Means you have the voting right, means you can vote for managing company. So if the company wants to invest in some project, so company will take the vote from the shareholders. So you can also vote that, and you can say that this project is or not, for example. So this is like voting right. So they will ask you as a what is your decision on that. So that is the voting right. Okay. But the preference shareholders, no voting right, because they are not the owners. Liquidation, when in case of liquidation means company don't have money. When the company don't have money, so whatever the assets company has, that will be sold off. When the assets sold off, that money, after the selling, that money will be first paid to the bondholders. That is the highest priority, paid before the equity and preference. So first paid to the bondholders the amount, and then the preference shareholders. Okay. Only if it is redeemable preference shares, then you have to pay the amount to the preference shareholders, redeemable preference shareholders. Otherwise, you don't need to pay. If you have this, if you have the more funds, then you can pay. But if you don't have, then you don't need to pay. And okay, sorry, it's a priority over the ordinary shares behind bondholders. So first you pay, first you repay, repay first this, and then you have to repay the amount to the preference shareholders. If anything is left, so that you can pay the ordinary shareholders. Okay. So maturity, you will never repay the principal amount to the ordinary shareholders unless liquidation, until liquidation. Okay. If your company liquidate, then you only pay if something is left. Okay. So maturity never, not necessary you have to pay. That is only you pay if it is redeemable. Fixed interest rate, fixed maturity date. So you have a fixed maturity date and you have to pay that principal amount. Okay. Risk level, risk is very low because you will get the principal and you will get the interest. Even if the company is in loss, you will get your interest and you will get your principal amount after the maturity. After the maturity, you will also get the maturity amount. Okay. And in case of liquidation, you also have the highest priority. First the company will pay you after the company pay to the preference and the ordinary shareholders. So this is the lowest risk and it has the moderate risk. It is the highest risk because last repaid will be repaid in the last. Okay. Tax impact, dividends paid from post-tax profit deductible. So dividend is ordinary shareholders dividend is paid after the tax. So that is the impact. And dividend paid from post-tax profit. So preference dividend is also paid post-tax profit. Interest is an expense. So this is the bond, and bond interest is paid as a interest, and this interest is an expense. This interest is an expense, and because of this interest expense, the tax will be lower. So tax will be lower because of this expense, the interest rate. So because of this interest paid by the company, the tax will be lower, and this tax is this interest is tax deductible. Okay, I hope you understood this. Its role is to manage the liquidity of the company. Okay, so the treasury management means strictly focus on the management of the liquidity to ensure survival and growth. And you know that liquidity is very important for the survival of the company. If you want to pay someone, so you have some cash or some liquid assets to pay for that. Okay, so that is mean by the liquidity. And in the liquidity we have the cash. Cash is the most liquid asset. Okay, so if someone want, if you have to pay someone, so you can quickly pay by cash. Okay, we have the debtors. Okay, and we have the short-term investment less than 1 year. So debtors we usually can collect in 3 months, 2 months, 1 month. So these are the debtors, and which means that you can easily calculate them, collect them within 1 year. So that is also liquid and short-term assets. If you invest it somewhere for the 6 months or 1 year, so that is also liquid. If you want to pay someone in the 1 year, so you can pay by that by selling that short-term investment. So that is meant by the liquidity, and This is the role of the Treasury Function, or I can say the Treasury Department. So what are the responsibilities? Responsibilities are short-term management, of the lending and borrowing of the cash, currency management. So these are the responsibilities of Treasury Function, and the long-term wealth maximization of the shareholders. It means that raising long-term finance, investing in the good investment appraisals, and what will be the dividend policy. So if we take these decisions wisely, so it means that the long-term wealth of the shareholders will be maximized. And risk reduction means assessing risk exposure and hedging the foreign exchange and the interest rate risk. Okay, risk management means assessing the risk exposure, how much is the risk, and then hedging means reducing the risk. And the risk can be the foreign currency risk and the interest rate risk. What is the finance manager do? The treasury manager do? Treasury manager advise on the cash management. Okay, so how can we manage cash? So if I want to pay someone, so from where I have to arrange the cash and pay that. Okay, currency issues like the change in the fluctuation of the currency, foreign exchange, and we might lose the currency value. So how we will manage that risk? Okay, and defending takeover. If any organization wants to acquire your organization, so and you don't want that your organization will be taken over by another, so how can you defend that takeover? So such kind of strategies are also made by the treasury manager. And the next is borrowing. So where can you borrow? At the lowest rate. Okay, debt capacity, how much can you borrow, and the reserves allocation, which means if you have 1,000 pound, so where can you invest that, so that you will get highest return? Okay, so dividend policy also means how much you have to distribute to the shareholders and how much you have to retain in the business for the use in the business. Okay, so this is the dividend policy. And the capital structure is how much will be the debt, how much will be debt percentage, and how much will be the equity percentage in the business. So that decision will be the capital structure, and where will be low, where WACC will be low. Okay, next is the acquisition and divestment. Acquisition, where how can you acquire the business, and how can you sell the business? Okay, which business you want to sell and which one you want to acquire. These are all the roles of the treasury manager. Next is the international treasury and centralization. International treasury department means the corporate treasurer in international groups, if in MNC, multinational corporations, in big companies. These international groups face specific challenge. So they have some specific challenge, like setting transfer price for tax efficiency. So for example, you have head office in country 1, okay, and in country 2 you have the branch 1, in country 3 you have the branch 2, in country 3 you have the branch 3. Okay, so you have 3 branches in 3 different countries, and you have the head office in your home country. Okay, so how can you set the transfer price? Which means that transfer price means that usually these businesses are the group this is the head office, and this is the subsidiary or branch subsidiary of that company. And usually they transfer, they give service, and also they receive the service. Also they receive the service and they give the service or the product. Okay, but how much price we charge from our branch or from our head office when we give the service or product to them. So that decision is called the transfer price. And that transfer price must be set where the tax efficiency, where the tax will be low. So which transfer price should I set where the tax will be low? Okay, so this is the role of the Treasury International Treasurer. Okay, and managing the cross-border cash transfer. So how can we transfer the money between the head office and the branch? So will you transfer by cash or will you transfer by the bank via internet? Okay, and devising international investment strategies, and how can you grow in the international market, and what will be the strategy? Okay, so what are the advantages of a centralized treasury function? So based on that, we have the treasury department. So we can set up one treasury department at head office, or we can set up a treasury department at every branch. Okay, so if we set up the treasury department, at every branch, every branch has its own separate treasury department. Okay, treasury department. Every branch has its own separate treasury department, and this one also has its own treasury department. So if everyone has their own treasury department, that is called the decentralization. And if you have the treasury department at only head office, okay, so that means that is centralized. Okay, centralized. Yes, or you can have the only one treasury department at anywhere. Okay, so if you have only one treasury department, that is centralized. If you have so many treasury department, that is decentralized. So what are the advantage and disadvantage of that? If you have the centralized treasury department, the advantage is that you will have the skill consolidation. Okay, skill consolidation means you don't need to employ the expert. You don't need to employ are expert in treasury management. Okay, you don't need to employ those experts who are treasury experts. You don't need to employ treasury experts at every branch. Okay, at every branch. So there is no application of skill. So you only employ at the head office, at only the one office. That means that remove the duplicate skills. Okay, and one highly trained central department can offer expertise unavailable at the individual company levels. Okay, next is the bulk. If you want to borrow, so you can borrow in the bulk. If you want to deposit, you can also deposit in the bulk, because you are taking the cash. If this branch has the cash, you will take that cash. If this branch has cash, you will take that cash, and you will manage the whole cash. When you manage the whole cash, so you can you can deposit that in the bulk and get the higher return. Okay, higher return. Okay. Also, if you want to borrow, so you can borrow for all the branches, all the branches. So if you borrow in a large amount, so you will also get the lower interest rate on that. Okay. Next is the risk. So total foreign currency exposure is appreciated and held efficiently by head office. So total foreign currency exposure is appreciated and hedged efficiently by head office, removing the need for individual companies to hedge independently, because you are managing the risk. You are managing the risk at the head office, so the branch don't need to do any any risk to mitigate the risk. So branch don't need to reduce the risk. Okay, so individual companies uh, uh, remove the need for individual companies to hedge the risk. Okay, liquidity efficiency prevent the scenario where one subsidiary borrow at high rate while other holds idle cash. This means that there are some times when this branch has cash. Okay, this branch don't have, and this has. Okay, so what happens if this branch don't have? So this branch can take the cash from the other branch. But if there are separate treasury department, so you cannot borrow from the other branch. If you have the central department, treasury department, okay, so the central treasury department know that this branch has the cash, this branch don't have, and this branch has. Okay, so central treasury department will transfer that cash to the to other branch. Okay, but if you have separate, so nobody knows if you have the cash or if you need the cash. Okay, so that means that liquidity will be improved. Cost reduction element carrying both balance and overdraft in the same currency. So if you have the same currency, if you need, if this branch has dollar 1,000, okay, and this branch need dollar 1,000 need. Okay, so I know that this branch has same currency, and this branch need the same dollar. Okay, and only it is possible if I know that this branch has $1,000 and this branch need $1,000. So I can then transfer that. But this means that you need the dollar and this has the dollar. So taking the overdraft in the same currency and having the balance can be removed directly by lowering the bank charges. Okay, so if you take money by the overdraft, you have to pay the charges. But now, because you are taking the money from the other branch, so you don't need to pay the charges. Okay, can act as a profit center for the group. Okay. Next is the advantage of decentralized treasury department. Decentralized treasury department means you have the separate treasury department at every head office. Okay, so the every branch. When you have the treasury department at different branches, so what happens that this will boost the motivation and the accountability. What does it mean? It means that if you ever go anywhere in any department store, have you ever done shopping at the department store? So in the department store, you go and you pick the products what you like. You pick the product and you go to the cash counter and you pay the amount and you go home. But if someone asks you that what do you want, and that owner will give you the product what you want, then you might not be satisfied with the product because you cannot see the varieties of the product, but in the department store you can see the variety of the products and you can pick what you like. Okay, but if the owner of the shop asks you what you want and give you whatever the product you like, so you might not have the motivation, or you may not feel good because you cannot see the varieties. Okay, so that is the same here. The autonomy gives engagement. If you give the autonomy, they are motivated, they will be very motivated because they have the gas. If this department has the gas, okay, if this branch B1 has the gas, so this branch can decide where this branch can invest. Okay, where this branch can invest and get highest return. But in case of centralized treasury department, if this branch has the cash B1, he cannot decide, this branch cannot decide where this branch can invest because the decision will be taken by the centralized treasury department. So that means that they are motivated if this is a decentralized treasury department because they can take their own decision and manage their own cash. Okay, this means that resources are more carefully held, directly responsible. Another is the local decision, fast and local decision, which means that local team understand the market best. If you are living in an area, so in that area you know very well about where is the food market, where are the restaurants, where are the shopping malls. Okay, so the same like if the local team understand, because it means that local team understand the market better. Okay, and allowing the quick and tailored response, and they will take the quick decisions which are tailored to the local changes without waiting for the head office, because now the head office do not interfere in the decisions of the treasury department, because now the department is decentralized. So the decision will be fast, tailored response, and the local team will understand the market, so the decision will be better and better than the centralized treasury.
Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.